Traders have amassed an $82 billion stockpile in New York, shifting nearly 400 metric tons of gold from London since November's US election. The reason? Fear. So what's going on? Let's find out. Today, we're diving into a major development in the gold market. There has been a surge in gold shipments to the US from London, and it's raising some serious questions about why this is and what it tells us about faith in Trump's America. There is a growing fear that the Trump administration may impose tariffs on gold imports, and this has had a serious knock-on effect in London, where the wait time to withdraw bullion from the Bank of England's vaults has increased from just a few days to as much as 8 weeks. This move isn't just about tariffs, but it's also about arbitrage. Gold future prices in New York have been higher than the cash market in London, and this has been creating an incentive for traders to shift metal across the Atlantic to take advantage of the price differential. Now, many of you will have seen the FT report that total gold flows into the US could be even higher than what's officially recorded at the COMEX exchange, as there have likely been additional shipments to private vaults owned by the likes of HSBC and JP Morgan. This is a situation eerily reminiscent of what happened during the COVID pandemic. Now, you may remember that back then there was this uncertainty over gold shipments and lockdowns, and this caused a similar rush to stockpile bullion in New York. And now it's happening again, but for different reasons. Now, the US is home for gold futures trading, with most contracts simply rolled or cash settled. However, with concerns over tariffs, New York dealers are asking for physical delivery. And this is something rarely done before. This has contributed to the bullion shortage in London and increased pressure on gold lease markets. London remains the global centre for spot and physical gold trades. It makes the rules, it warehouses the metal, and it runs the global price discovery process known as Loco London. However, gold is now flowing wholesale out of the UK vaults and into US ones due to the price differential between the two locations. This is an arbitrage trade. This shift is putting immense strain on the delivery systems, with each movement of gold taking longer than average to complete. The surge in demand is stretching these logistical capabilities to their limits. Now, another key factor to consider is the impact on the gold leases. London is the hub for bullion lending, where banks borrow from central banks or other market participants and lend to institutions like jewellery manufacturers, miners, and short sellers. But if the cost of borrowing gold spikes, as it has, then this trade quickly becomes unappealing and expensive. Interbank gold lease rates, which typically hover below 0.5%, recently shot up to peak up around 12%. And that is a massive jump. And it's forcing short sellers to unwind positions, leading to a sharp rise in gold prices. As speculators who were betting against gold close out their positions, the price has surged, successfully breaching those key resistance levels of $2,725 an ounce. But it does remain, at the time of recording, just shy of its all-time high of $2,790. Of course, it's worth mentioning that President Trump hasn't specifically mentioned tariffs on precious metals. But the fact is that the risk has been enough to push gold deliveries to New York, as some market participants hedged their positions on the US COMEX exchange, while others seek to profit from the premium of futures over the London spot price. Of course, the Bank of England is not a commercial vault, and it's struggling to keep up with the surge in gold borrowing requests from banks. The so-called Loco London free float, the gold available for OTC trading in London, has of course fallen as a result of these shipments. In the last 2 months alone, 12.2 million troy ounces of gold have been delivered to COMEX-approved warehouses, raising the stock levels there by about 70% to 29.8 million ounces. This is the highest since August 2022. This shift has even drawn the attention of the British Parliament's Treasury Committee, where Bank of England Governor Andrew Bailey had to downplay concerns about the security of the London gold market, stating, "We are not in the gold standard anymore. It doesn't have the significance for policy in that sense." And he also reaffirmed that London remains a key market for trading and storage. Many commentators and industry insiders are now predicting a major revaluation of gold and silver, as fiat currencies and bonds undergo a long overdue devaluation. So what does all this mean? Well, it means that gold is once again at the center of a rapidly shifting financial landscape. Whether this rally continues or corrects depends on policy decisions, it depends on investor sentiment, and it depends on ongoing liquidity issues. But here's the key point. Investors should not worry about gold itself. Gold is still here. There's no risk of it disappearing, no risk to its fundamental value. What we're seeing is not a shortage of gold, but a shift in where it is stored and how it is traded. And this is why gold remains the ultimate safe haven asset. Through uncertainty, political shifts, and financial turbulence, gold continues to hold its value and play its role as the anchor of stability. And this is exactly why investors turn to Goldcore. Our gold is segregated, allocated, and independently verifiable, unlike the fractional reserve system in bullion banks. Goldcore ensures that your gold is your gold. It's real, it's physical, and it's fully owned by you. And this is another reason not to rely on the financial system and central banks when it comes to the security and investment of your assets. Protect yourself with real, allocated gold from independent, trusted bullion dealers. This is a super brief, top level look at what's going on, and there is a lot more to it. So we'll be bringing it to you in the coming weeks. If you want to stay ahead of gold market trends and financial news, then be sure to click the button, subscribe, drop us a like, and of course, let us know what you think this means for the future of the gold price.